So today I was asked about the options for financing when you're buying a house, right, on Long Island. Glenn Lombardo, Douglas Elliman Real Estate, East Islip, Babylon, New York. It's pretty straightforward. It's not just Long Island specific, but I'll get into it. You have a few options, right? You have the first option, which is the most common, is conventional financing. What does that mean? Conventional means non-government financing. It's conventional, right? It's normal, it's straightforward financing. Those types of loans are typically reserved for borrowers, future homeowners, they're borrowing money, borrowers, right? Who have credit scores that are over 700, who have documentable income, W-2s, pay stubs, their employees, taxes come out of their pay stubs, right? And they have sizable down payments, 5%, 10%, 20%, 30%, 40%. So when you fall into the top echelon of borrower, you're most likely going to get a conventional loan, okay? They offer the best pricing. The pricing means the interest rate, the price that you're gonna get for your loan based on your credentials. And the best credentials are gonna get the best possible deal conventional. So if you're kind of in the middle, you might not want to go conventional, even though you may have the option to. Okay, that's number one. Number two, you go FHA. What does FHA stand for? It's the Federal Housing Authority or Administration. One of those two. So these are government-backed loans, right? So there's a little bit more wiggle room for the lenders to lend the money to borrowers whose qualifications aren't as strong as the conventional party, right? So these FHA loans, they're easier to get, but they're a little bit more expensive, okay? And they're not, the pricing, the rate that you get isn't necessarily based on your specific qualifications. It's kind of like if you're taking the FHA loan, you're gonna get the same rate as somebody else is taking the FHA loan, right? The rates are excellent, they're very good, okay? But there's something called PMI, private mortgage insurance, that's included in the monthly payment, which makes it a bit more expensive. It's like, that's the extra risk essentially, right? That the bank is charging you. It's private mortgage insurance. PMI is included in the monthly aspect of your payment to make it go higher. And there's something called MIP, mortgage insurance premium, that's included on top of the loan. Okay, I guess it's another risk factor that the bank and the government tax on to say, hey, look, typically you wouldn't be eligible for financing, but in this case you are. You can take a government-backed loan, you can get the home you want, but it's gonna be a little bit more expensive, okay? Very, very viable option. So many people choose FHA loans. It's actually a great product, okay? Another type of loan you can get is a veterans loan, okay? A VA loan. Right? VA, short for Veterans, Veterans Association. Now, the cool thing about a veterans loan is that you can finance 100% of your deal, okay? You don't have to put a down payment down, which is really cool, okay? It's really cool, like, to have that option, right? It's not so cool when you present that offer to a seller, because if they have other offers with large down payments, sometimes it might be hard to convince them to take your deal. You probably have to be much higher on your price, realistically speaking, right? To get that offer accepted if your terms aren't as strong, right? This is just from experience, guys. Like, I have nothing against VA loans. I love our veterans, right? And I think it's a great product. You don't have to put any money down. It's like a huge thank you for your service, right? And I think it's awesome. But in reality, you're gonna have to compete with conventional borrowers who are putting down, 20%, 40%. 40% of 500,000 is 200,000, and you're putting down nothing. So you'd have to come in really strong on the price or find some other way to convince the seller to take your deal, okay? A VA loan is also a government loan, so that's cool. It's also a government loan, but it doesn't have that PMI, which is pretty cool. That monthly PMI it doesn't have. I believe, I'm not a loan officer, but I believe VA loans do have MIP, so the loan amount is increased for the risk factor, but it doesn't have the monthly PMI, which is really cool. So you can finance the whole thing and not have any additional monthly expenses. Great product. And the last loan I'm going to go into today is called a renovation loan. Okay, it's also called a 203K loan, right? So the 203K loan is the FHA, the government version of the conventional renovation loan, right? So what's a renovation loan? It's freaking awesome. It's like the coolest, most underutilized product out there. Okay, what does it do? It allows you to finance any potential renovations that you might want to do on the property you're buying, right? Any purchase mortgage loan is just for the property itself. And if you're going to fix it up, you have to come out of your own pocket. That's a fact, right? But what a renovation loan is, you can specify what the subject to value will be, the after repair value, right, will be to the bank. So for example, if you buy a house for $500,000 and it needs $100,000 in repairs, okay? And once you put in those $100,000 in repairs, the house is gonna be worth $650,000, right? You can specify that to the bank. And the appraiser, when they go out there to appraise the value of the home, okay, they're gonna indicate the after repair value to the bank of $650,000, assuming that it's in line with what you're saying, right? And if that's the case, you could take out that $100,000, right? And you could finance that $100,000, and your purchase price will be based off of $650,000 instead of $550,000. Really cool. So you can finance the construction work, the renovation that the house needs to get it to where you want to be, right? The only caveat, if you even want to call it a caveat, I mean, they don't just hand you like a check for $100,000 at the closing. Like, that's not realistic. What they do is, right, they give it to you in segments, right? They'll give you one phase, they'll give you like 30,000, and they'll send somebody out there to make sure that the work was done, right? And it was legal, done correctly. And they'll give you another phase, like another 30,000, right? Send somebody out there again. And then they'll give you the final phase of 40,000, and that'll complete your project, okay? At the end of the day, it's done correctly. They're not just gonna hand you the money. It's not like cash out at closing. It's done in phases, but it does serve its purpose. So great product, renovation loan, FHA version, 203K. Those are 4 different mortgage products for financing a residential property on Long Island, New York. I'm Glenn Lombardo, Douglas Elliman Real Estate, Babylon, East Islip.